property. It has water.
Okay, well, thank you. That answers my question.
I was looking the other day at some that's part of the P River, so not too far south, but from here. Just thought that would be, anyway.
Well, and
This has
we need
here
to
in
see-
Springs that,
Mm.
and it has been a Cherokee Indian reservation there. That you can find this there and everything, and we can abstract it went back to.
Well, we are right at noon, so let's go ahead and get started. Thank you both for being here today. I told Cheryl before you got here, and I didn't know if anyone else was coming in person, that she was gonna be our star student. So now y'all
I
have the
just
dual.
And when I respond, unless I told you.
I do too. You just never know with weather and everything. So this is Celeste,
Okay,
Dorman, and Cheryl
Halsey.
Halsey. Make sure I say it right.
Mhm.
And on Zoom, which you can't see them now, we minimized them, but Sid is on Zoom and Lee Kaler in Birmingham is joining us. And we will be recording this and uploading it to our YouTube channel for anyone who is not able to be with us today. There is some bad weather out there, so we have a couple of people, I think, who were not able to make it. But thank you very much, and I'm going to go ahead and turn it over to Greg.
okay, well, thank you, everybody, for coming, and thank you all for being online. This is the third little session of this study group, and this is, we had one on the 5 trends of the philanthropic frontier, then we had one on the family love letter. I'm not familiar with the family love letter. And this one is on financial tools to benefit family and charity. And small group, so we can keep it very informal and very engaging as we go along. So there'll be questions on each slide. I'm sure there will be. So let's go ahead. Let's see. And if there's questions online, you can drop them in the chat. We'll go over the 6 most common financial tools, and we can take questions as we go along. So first off, but before we, as we get going here, there's this meaning of life is to find your gift. The purpose is to give it away. That's a great, I think that's a great segue into this. So I guess the question is, what is the impact of your financial generosity? And really there's the good, the bad, and the ugly. First, the good. You know, financial generosity is a great way of achieving goals and passing on family values in terms of what is really important to the family. It's also a way of investing in yourself and in loved ones, and serves as an incentive. It can serve as an incentive. It's if your financial generosity is such, for example, in a trust of some kind, it can be a great financial incentive for children and grandchildren. And financial generosity, we have this aspiration to give. It really makes us feel good to give. And financial is one way of doing that. And obviously helping nonprofits and causes that are important to you is also really the good of it. But there is bad. If there's poor financial stewardship of your assets and your income, it can actually reflect, especially with family love letters, if one is not completed and that kind of thing, it can be very, it can be inconsistent. Financial generosity can actually be inconsistent with the values that you want to perpetuate with your family. And it can actually serve as a disincentive. We've probably all heard of the trust babies that are spoiled, okay? And that could be a disincentive for people that are, and my daughter in college actually experienced that here in Auburn with a trust baby she had as a roommate, and she couldn't believe it. Anyway, and also a bad could be excessive taxes and spending excessively. And so we'll cover a lot of that today. And there could be others. You may have others that may be bad. You may want to suggest on that. Then there's the ugly. And I've seen this happen when financial generosity. I've seen actually, a client a long time ago that was a widow that got taken advantage of overseas and just basically drained her assets because she had a relationship somehow on the internet with someone overseas, and it drained. I ended up having to release her as a client because she would not listen. And so that could be, you know, be emotionally taken advantage of. It can also be disruptive to the family in terms of how it is left through inheritance or gifting, and if it's not perceived as being fair. There could be unintended consequences, and I use an example of one that I came across when, and we'll get into this, a beneficiary form. Whoops, it was left to the first wife. Okay. You know, upon death of someone, and that's real world stuff. That can also create distrust if there's not good communications in the family, and actually, this is more common than you see if you have siblings that start getting, money can do that. Money can do funny things to people, especially siblings that don't perceive things as being fair.
Yeah.
And of course, there's excessive taxes and fees, and we'll get into all that, and encourage dishonesty, and I've seen that too. I've seen kids take advantage of their parents, and all the issues that can go along with that. Do you all have any input or any questions on what I've covered so far? Okay, I'll just move right along then.
I could give you input on all of it.
Yeah, I'm sure you can, because I think we've all experienced it in some way or another, or heard stories. And we can get into that as let's go through this, and we'll address a few more things here.
We can stop recording at some point if we want to.
No, I wouldn't give it to you, but I could.
It's kind of like we got the stuff to cover, and there's a lot of stories we could all share. Let's talk about financial assets for personal generosity. And I'll just kind of go through these just so people are aware what they are. We have cash that typically are the loans, the credit, the debit, writing checks, all those things that we do with cash. Talk about appreciated assets. If you're familiar with the concept of appreciated assets, if you have, let's say, a farm you got a long time ago, and it's worth whatever, I'll pick a number, $100,000, and now it's worth $3 million. That's an appreciated asset. So if you sold it and you got it at 100,000, and it's now $3 million, and you sold it, you got to pay a lot of taxes on it, or you could pay a lot of taxes. You have the same for business and stocks. Stocks is typically what we think of as being appreciated. Like if Mary Ellis buys a penny stock for $1 and then she sells it for $101 a year and a half later, she has $100 of capital gains that she has to pay taxes on. A very simple case. There's ways of getting around all of this. That's what's so much. You can be so creative and fun. It can actually be fun trying to figure out strategies to deal with all this. Then you have insurance, which is typically life insurance and annuities. Those are insurance products that we'll be dealing with. You have retirement assets. If you're working for a university, you have probably a 403B, I guess. And of course, then there's a 401k and there's a 457. There's all those retirement plans that are part of your retirement assets. So we'll talk about that. And then the collections, whether it be art, stamp, baseball cards, all kinds of collections, furniture. And then business. And typically those business, so you have business stock. If you have, let's say, a C Corp or an S Corp or a benefit corporation that we talked about before. Or you can have actually the brand of the business. You know, like Chick-fil-A has quite a brand reputation is what we're talking about. And then there's the business of the in-kind assets of business, such as a lumber store that donates money for Habitat for Humanity. Okay, that's an example of in-kind business assets. And we'll get into that as far as how all these assets can be used for family and can be used for your favorite nonprofits. when I was working with clients, I constantly use this graph of, it's used for assets with financial advisors to show the accumulation of financial assets. And as I got working with Kim and the Kerry Center, I realized it really is a life journey of personal generosity we're all on. And I converted it from thinking about assets to thinking about age and our financial generosity. And so we all go through this life journey of of 3 phases: accumulation, opportunity, and distribution. And typically, as an example, Mary Ellis, there being around the 20-ish age, she's what I term is called a life learner. Okay, and that's the first 50 years of life. Then you have the middle, and then you have the last phase. So that's the life journey. And so I guess the question for each of you is, where are you on this life journey? And just as important for this whole generosity concept is, where are your loved ones? You know, some of us may be in a distribution stage and we have grandchildren. Some of us may be in an accumulation stage and we have our papa and our parents. And so we can, by being knowledgeable, we can help guide our loved ones because we're more empowered. So what phase are you in? Are you single? Are you a growing family? Are you an empty nester? It's all part of the family concept here. And lastly, financially. Financially, are you secure? Are you comfortable? Are you secure and have a little bit of extra money? Or are you affluent and you have assets? And you can be more generous if you choose to.
What comes before comfortable?
Huh?
I'm in my little box.
Yeah, I'm pretty sure there's a few boxes maybe like that. But I think you all get the concept of what we're talking about here. So all those are part of this whole, instead of kind of setting the stage here for this generosity aspect and the 6 tools we're going to be talking about. Okay, the strategy of financial generosity. Okay, this last thing I had with the life journey of generosity. Well, you all remember Jack and Jill going up the hill? That's where I got the names Jack and Jill. Okay, they're going up the hill, but they're trying to figure it all out. Okay, and typically they have the asset types. We talked about those: the cash, the appreciated assets, and then the financial tools, which we'll get into. And then your situation being what stage are you in, and also, what kind of family situation are you in? All those aspects are important in terms of your situation. And then there's questions. So Jack and Jill here have some questions on what do they do? Where do I go from all this? And what you do is you take these strategies in the middle with a solo mix and match, and you figure out your strategy for financial generosity. And for most people, their family comes first. Some it may not be that way, but for most people, the 3, well, you can give it to your family, and then you say, okay, where else would I like to give? That's important. But by knowing the tools and the strategies, you become confident, capable, and comfortable in doing what you're doing. And when you talk to advisors, you can actually go in there and say, hey, I'm thinking of such and such. Can you tell me more about it? Or however that may work. But if you are empowered with the knowledge and the know-how, you become more capable and confident and become super. So here we are. I don't know if you all have heard of the concept of money in motion. Have any of you all heard of that concept? Okay. Typically, money is in motion, meaning overall life journey of personal generosity. Money is in motion, and what it means is that money is moving either as income, and we'll kind of exclude expenses because that's part of living, but it's where money comes in and it goes out, and it's moving. It could be income, it could be expenses, it could be assets. And you have a change in ownership or custodian. And there are certain periods, life events where we have money in motion. And actually, I'm writing another book on money in motion in 4 key events, which are in the 20s, in the 40s, in the 60s, and in 80s. I use those things, meaning distribution, retirement, and I call it halftime of life, meaning when you're in your 40s. And then when you are scouting life's frontier, as Mary Ellis is doing, okay? But anyway, that's, so basically have money in motion during those periods. And examples of income, inheritance, sale of a home, sale of a real estate, there's a property or your house. When you give money, it's money in motion, okay? And so that's a key concept to understand. And typically, when money goes in motion, other than the expenses we all have, it can go one of 3 places. It can go to yourself or your family or your loved ones. And that's typically where most money in motion goes. Or it could go to your favorite causes or charities. Or the third place it could go is to your favorite government. Okay? And unnecessary fees. And I don't know about you, but I think most people would like to minimize that last one, to taxes and unnecessary fees. And believe me, we can do it, a lot of it. Maybe not as much in the accumulation phase, but in other parts of the stages, the other 2 phases, there's a lot of ways of being creative to combine all this to avoid a lot of taxes and unnecessary fees. And that's what makes this, at least to me, very fun to be creative and helping people understand and learn all this. So this concept of managing risk, I don't know if you all have heard of that term. That can be used for anything, whether you're talking about investments or whether you're talking about getting in your car. You think about your risk. There's 4 ways of, let me use an example of the car, which is so easy. You can avoid the risk of being in a car accident by, you can accept it and just go and drive. We do accept that risk when we drive. We can avoid it by putting on our seatbelts, being hurt. We can reduce, that's how we reduce it. We can avoid avoid driving, but just not driving. In the city, just take something else. We can reduce it by putting on our seatbelts, and we can transfer it by saying, well, let's see, I got to go down to the store and it's nighttime and I'm uncomfortable driving. How about you taking that risk? I'm not saying that instead of me going, how about if you go? Or if you're going down to somebody's got to go to a bad part of town, instead of me going, why don't you go? We're transferring that risk to someone else. So anyway, there's 4 ways of managing the risk, and what we're talking about here is how 4 ways of managing taxes, and you can do the same thing. So you can accept it, you can avoid it, reduce it, and transfer it by default of not a lot of times we accept the risk of taking taxes, and which case we pay them. Okay. Any questions on that so far? Okay. Hopefully it's somewhat clear. Key money in motion scenarios: income and spending, transfer of appreciated assets. Let's say selling your house and you're moving, you're retiring and you're moving. A distribution upon death, and that's where that family love letter from that last session we had. Okay, moving right along, let's talk about 3 basic financial generosity tools on this life journey of personal generosity. First one, and you all may take notes and we can have more questions and conversations on this as we go through, is cash gifts. Okay, cash gifts. Obviously, it comes from our income or our saving. It's really the most common thing people use. It can be texting and online for charity. There is a tax deduction for the gifting. I don't know if you're familiar with above the line contributions, no matter whether you itemize or not, you can deduct, I think it's $300 per person now above the line. So for cash gifts, so that's a tax deduction. Check with your accountant. I'm not providing advice here. I'm providing education. Okay. So you can do that. So in terms of a tax deduction, then there's the item of itemizing or whether you take standard deduction. Okay, so, but anyway, that's the whole idea of cash gifts. You can do a bequest of death, which basically means in your will or in a trust, a revocable trust, you can say, I want $10,000 to go to my favorite granddaughter. Okay, and she could receive it tax-free. And there really isn't a limit on that. So that is a way of gifting money. Typically on gifting money, I think the actual, the gifting limit per person per year is $17,000. Okay, I think it's 16,000 this year. This year it's going up to 17,000. So let's say Mary Ellis's Papa, right? He says, I have excess money I want to give away while I'm living, and I want to make my granddaughter, hey, can you give the $17,000? He can give you $17,000 to you, Mary Ellis. Or he could say, and of course, on the very first part, we talked about being a two-edged sword of money, being good or bad. Okay, Mary Ellis, I'll give you this $17,000 if it's used only for your education. Okay, and by the way, I'll give it to you in part, maybe as a down payment to start with. And if you do complete your course and you get a B in it, I'll give you another $17,000 the next year. There's ways of providing incentives for that instead of just saying, here you go, Mary Ellis, here's $17,000 going over Europe for a couple of weeks. Right? So there's ways of doing that. Okay. Mary Ellis, you could do that, right?
Good, you're up.
Okay. Anyway, I'm kind of covering a lot of territory in a short time period here. So anyway, the cash gifts is a generosity tool. It's the most common one. Let's see what I taught you here. Oh, I talked about itemizing. The standard deduction for single filers is 13,000, and for joint filers, it's about 30,000, 29,500. So, you know, there's ways of kind of even dealing that if you take the standard deduction. The other thing is this appreciated, the second tool is this appreciated security. Example, stocks, real estate, business, a home, a farm. Gifting is easy and simple, but it does require some thoughtful tax planning. And there's ways of getting around that. One aspect, for example, I don't know if you all have heard of step up in basis. Have you all heard of that concept? Okay, let's go back to that appreciated penny stock that Mary Ellis bought for $1. Okay, and now it's worth $101. Okay, and she wants to sell that. Okay, so she sells it and she pays her capital gains rate. Well, she'll pay like basically zero capital gains because she doesn't have much income. But assuming she's a really high income, okay, because she's paying attention to all this stuff, and she's in, you know, she pays 20% on that, so she ends up paying $20,000 in tax. It's $200. Okay, it's $200, so she pays $20 on taxes. Okay, but it's okay. That's the appreciated, so she has to pay those taxes. Okay, but let's say I'm talking about step up the basis. Let's say that Mary Ellis has a stock, and she goes out and she, whatever reason, sorry, Mary Ellis, you get run over by a bus. Okay. So the reason I'm saying that is upon death, there is a step up in basis so that if whoever gets that property sells it and she owned it at $101 and sells it the day after she passes away, zero taxes. Okay. So a prime example of this is, let's say you have a farm or a cottage or a vacation home, and it's in a revocable trust in a surviving spouse's name. And that surviving spouse passes away, and it's named in the trust. And it has an appreciated value of, now it's worth, let's say they bought it for $100,000 and now it's worth $800,000. What's in the trust? It passes, she passes away. It's $800,000. The children inherit the property. It's $800,000. There's no tax liability because it was in the name of that person's trust, in her name. Okay, does that make sense?
Okay, there's still the inheritance tax portion of that, okay?
If there's an inheritance tax, something, if there's a liability on an inheritance tax for the state.
If it's in an irrevocable trust, it doesn't have inheritance tax, does it? It would just have capital gains.
Right, like I said, I'm not in the advice business, but, generally the tax, irrevocable trust has its own tax bracket,
Yeah.
okay?
Now, what is the term exactly? Step what basis?
Called a step up in basis.
Step up in basis.
Okay, so that's a great tool. For example, if someone has a mother or grandparent or something like that, and they own highly appreciated assets, it may make sense, once again, this is education, not advice, it may make sense to say, keep it, don't give it away while living. And there'll be a step up in basis upon death. And gets distributed to whoever it goes distributed to. Okay? Hopefully, but that requires a little bit of planning. Then there's the concept of gifting,
So
okay?
then if you have inherent real estate, for example, and it was $100,000, I'll use your early example, you paid $100,000. Whoever you inherited it from paid $100,000 for it, now it's worth 3 million. If you sell it, do you pay capital gains on that 2,900,000? Or is that what gets?
Well, if that person is still living,
No, that person passed away.
the person passed away,
Yeah.
and it was in that person's name, or their
Yes.
name, their name as a trustee of that trust.
Right.
Okay, and they pass away, there's a step up in basis on that property.
Okay.
Okay,
And so then later, if like say she were to inherit it and then she's like, I don't really need this property. I'd rather have the money from the property.
sure,
And she sold it, she wouldn't pay capital gains on it or?
well,
would she pay?
if the problem, it depends on when she sold it, if she waited another 20 years to pay it, she'd have the difference between when she inherited and the property when she sold
But what if she sold it as soon as she inherited?
it, right? Then essentially be no taxes on it.
Okay.
Okay? Okay, now that's about as far as the family goes.
Wait a minute. Is that just if the property is in an individual name or a trust name, but not if it's in a business name, or does that matter?
It's individual.
Okay, so if a property is owned by a business,
You'll have to see your account.
okay,
Okay.
but there's not the same tax benefit.
I wouldn't think
Okay.
it would be the same, okay?
Your liability is different too during survival if it's in the
Right.
business name. There you go.
But that was pretty much about families, okay? Because that was typically for most people. Then let's talk about, okay, I'm living and I love the Women's Philanthropy Board, okay? And I have a stock that's $10,000 of appreciation. And I really don't need it, and I really want to help the Kerry Center and the Women's Philanthropy Board. Why don't I just give this stock to Auburn University Foundation, specified for the Women's Philanthropy Board, and then I can get a tax deduction for that amount, for the $10,000. Oh, but my standard deduction is 29,000. Man, maybe I ought to bunch all my gifting in 1 year. It's called bunching. So I say, I want to make a gift to them, but I also have a contribution to the church I want to make. Maybe I'll bunch my 2 years of contributions to church and to the Kerry Center and do it all on December of this year. So that I will exceed my itemized deduction. Instead of taking my standard deduction, I can now itemize because I have a whole lot of deductions. More than the 39, it's called bunching. Okay, the concept kind of, okay?
You get a
So-
better tax benefit by putting multiple charitable gifts together in 1 year versus spreading it out over several years.
Bring yourself above the level
Yes.
of
Above the-
where you can itemize.
Right, so, because right now, you know, when they changed that as far as the itemization a couple of years ago, it knocked 90% of the people into the standard deduction mode. And whereas a lot of people had been doing standard, you know, taking itemized deductions, now it didn't make sense for them. But there's still a way of doing that if you want to bunch it in one time. So I want to say, oh, and you want to do it while you're living, obviously. Okay? So it's called bunching. Okay, so you can say, okay, I owe 5,000 to church this year, 5,000 to church next year. Okay, I'll put them together in one, take care of both of them. Sorry, church, you'll have to figure out the cash flow. I'm just, you know, but you're getting $10,000. I'm just using that example. And by the way, I want to make a contribution to this and that. I'll do it all in 1 year. Does that all kind of make sense? Okay.
Your goodwill deduction no longer counts. This doesn't bring you up to the itemized level.
Can you say goodwill, and can you say your goodwill deductions and bunch them?
That in your will,
No.
No, your goodwill
You know, they give you
donations,
receipts,
your receipts.
you do 100 at a time, you can't deduct it anymore because of that itemization rule.
the itemization rule, this 30,000 itemized deduction for a couple, I think is what I have. Is, you know, it's really high.
You can't.
So
do
most
that
people
anymore.
take the standard deduction.
Yeah, I know.
So it's just a matter of looking ahead and thinking what you want to do, and do you want to exceed that? Otherwise, you don't get it, okay? Once again, you're becoming more knowledgeable and capable. And when you go into your accountant and you talk taxes and you say, okay, I want to bunch my, you know, they'll kind of be blown away if you talk about bunching with your accountant. Okay,
It's practically better to do the after death bequest
yeah. So,
than nobody pays
okay.
taxes on.
So anyway, I covered appreciated securities, so that's the contribution for, it has to be to a 501c3, okay? Nonprofit organization. For example, if you want to go to the Chamber of Commerce, no. It's a nonprofit, but it's not a 501c3, which is a charitable tax deduction. Okay? Beneficiary designation, I love this. Beneficiary designations are so important and so overlooked. The retirement accounts, you know, you have beneficiary designations, and typically you have primary beneficiary designations and contingents. It's important to fill out the contingents, especially if you're older. Okay, life insurance, you have beneficiary designation, same thing. Consider the tax cut, checking them update, check for unintended consequences. I mentioned that little story about, you know, a dentist that did not change his beneficiary designation after he remarried after a prior divorce, and he said, and he passed away, and his divorce, his ex got the life insurance proceeds because he didn't change the beneficiary designation. Okay, and that has nothing to do with the will. That's a contract, basically a contract for beneficiary designations.
I bet he was used to his wife telling him.
And your will cannot override that. Even if you put in your will that you want life insurance to go to your second wife, the signature at
No,
the
no,
life insurance company overrides it.
typically when I had been working with clients, the intent was, we didn't even probate the will because everything was taken care of outside the will. This whole Hollywood thing, or let's go read the will. We don't even want to deal with the will. We want everything to pass privately, quickly, and easily via what they call will substitutes, okay? Which is based by contract, by trust, all those other ways of dealing with assets. Will is the transfer of last resort. Okay, and a will is necessary, and it may be for family situations because of what you have a special needs child. There's all kinds of situations where a will is always needed. Okay, but it is really at least for my planning and with my clients when I was working, is most of my clients, we never, didn't even go down to the courthouse. Didn't have to. It was all passed privately and in the right way. Does that all kind of make sense? Okay. I talk about beneficiary designations. One thing's on the retirement accounts. Okay. Let's say Mary Ellis's papa, okay, has an IRA, okay, that he's got a bunch of money in. IRAs and 401, those retirement assets, there's a special rule called income in respect of a decedent, which means that if you inherit a retirement asset, you get whoever inherits it pays the tax on it. Okay? Think about beneficiary designations. Wow. They gotta pay taxes on, let's say you have a $800,000 IRA. And you are the child of, let's say it's Mary Ellis's father is the beneficiary of the IRA for her papa, okay, grandfather. Okay, he looks at it and he says, let's see, Mary Ellis is the contingent beneficiary. I think I don't need that money as the child of papa. And I would much rather have Mary Ellis get that money than me. So I will disclaim being a beneficiary and it will go to my contingent beneficiary, which is Mary Ellis. Now she has to pay the taxes on that money, but now maybe she can go to Europe, right? We're just kind of, but beneficiary designations are really powerful, and especially powerful for charity, because, and we'll get into this in a little bit, as far as anybody that receives IRA type money or retirement money pays taxes on it. If it's a charity, it goes straight to them. Okay, so you could think about how the strategies of how you could have beneficiary designations, and we'll get into that a little bit. But also check for unintended consequences, because it can be bad. Once again, it could be like a trust kind of situation. If Mary Ellis or someone young inherits a big IRA money and they're not responsible, that could be a disincentive to them and could be spoiling. Okay, so it may make sense for it to go into a trust that could be managed on their behalf. Sorry about that trip to Europe there, Mary Ellis. It goes into a trust now. Okay, but maybe the trust documents are such that, and wording gives you a lot of leeway. Okay, I'm just kind of throwing out ideas here. Okay, so we're going to probably move along. I don't know how we are for time. I want to talk about accumulation and tax risk management and accumulation, because a lot of people are in accumulation mode. Mary Ellis and others aren't. You have income deferral, so that's a great way is through your 403B. Is just stock away as much as you can there, which case it postpones, it avoids the taxes. The other thing is have a business. I don't know if having a business is awesome, because there are a lot of opportunities to shelter income tax through the business legally. Okay. And then I mentioned about bunching. Okay, but other than that, if you're getting a W-2 and an income, salary income, your choices are very limited, other than through the retirement plan. Okay, but you can have, if you have a business, a side business, for example, you can have a solo 401k and still sock away a lot of money if that business is very profitable. Okay, so there are opportunities, but you got to be anticipate and be smart about it. In that, of course, then on the tax, on the other side, you have this asset step up we talked about in beneficiaries, and a lot of more planning is needed more as you accumulate, and then you have the opportunity during the opportunity phase and distribution phase. moving along here, I covered those first three, and hopefully there's some ideas that you all can take away and say, at least to the idea, you could talk to your family members and your advisors and just bring up topics. Here's the donor advised fund. Are y'all familiar with the donor advised fund at all? Anybody familiar with it? This is the affluent person's private foundation, someone that doesn't have $250,000 or more to throw into a private foundation. And they are great tools for families. They're community foundations sponsor major investment firms, Vanguard, Schwab, any of the major investment firms offer their foundations offer donor advised funds. It's a great way of helping perpetuate and working with family to perpetuate family values. Okay, and the idea of generosity. And you can fund it with cash or appreciated securities. So let me show you a little diagram here. This will help. Here you have appreciated security, you have appreciated assets. So Mary Ellis, now that $1 stock is now turned into $100,000. Way to go, great investment. Okay, but it's all appreciated asset. But she's being a philanthropist and being very caring about whatever you care about. She says, I want to set up a donor advised fund. So I'm going to take that $20,000 of that I'll be paying taxes on, and set up a donor advised fund with under the umbrella of, I'll pick, the Fidelity. Let's say Fidelity. I'll set up a family donor advised fund under Fidelity, and I'll get $20,000. I'll get a tax deduction for the $20,000. It sits in this account called the Mary Ellis Family Fund. Okay. And she can go in there and take this fund and say, I like that nonprofit, I like that nonprofit, and I'm going to give them $500 and give them $500, and she can do it whenever she wants to. She doesn't have to do it when she funds the DAF, okay? Marilyn,
Is that fund making money?
yes. And you pick, it's just like your retirement account, you pick different investment. You can be real conservative, you can be very aggressive. It's a great tool for a family to be able to give to, and then they distribute their money. You can do it sequence. You say, oh, by December 1st of every year, I want to give $500 to the Women's Philanthropy Board, and they just do it. It's awesome. Okay.
Is it better to set that up while you are actively earning income?
You can
Because you're probably going to be in a higher tax bracket.
you can set it up any time, and anybody can set one up. But typically, the minimum is around $5,000. Most of them are $10,000. A community foundation. A lot of people love their hometown, and so they like to set up the community with the community foundation because they want to support their hometown. But you can set them up with the national firms, Fidelity, like I said, Schwab, Vanguard.
But since you get the current tax deduction for whatever you put in, is it better to kind of do it earlier rather than later? I mean, as you're working or as you're generating.
Well, you typically for people in the accumulation stage, unless you're making a really high income, you really don't have because you have other response. You got colleges. I mean, you got your own retirement. You got all this other stuff. So unless you have an appreciated, for example, appreciated business assets can go into a donor advised fund. Okay, so when people are thinking about selling a business, for example, it makes a lot more sense if they're charitably inclined to plan ahead instead of waiting till after they sell it. Because there's a way of, and we'll get into it a little bit, a way of dealing with your distribution of your business or your real estate or whatever it is before the event. It's really important to obviously require some planning. Now, if you just have a high income, you're a high income person, you have a bunch of assets and you have appreciated assets in an investment account, a DAF, a donor advised fund is great. And it's what's really good about it is the use Fidelity. Fidelity is a nonprofit. They have a Fidelity Foundation, not 501c3. And you are under their umbrella. So you, as a family or an individual, quote, advisor, are advising on the distribution to Fidelity. But if all they do is say, okay, I want to look up a nonprofit in Auburn, Alabama, that has deals with women, that's associated with the Auburn University. Oh, Women's Philanthropy Board.
So WPB is a 501c3.
Well, as part of Auburn.
So then
Yeah.
technically, you could do this. Put 10,000 in whatever, every year on a certain date, distribute $1,000 to WPB.
Sure,
That's my dues.
yeah, there you go.
We have several people that do that.
Oh,
Through
okay.
that, like that.
Oh, by the way, I've got to make a contribution to my church every year. Okay? Hey, put it in a DAF, okay, and just have them send it to the church every year.
So to me, and tell me if I'm wrong on this, say you have that appreciated stock
Mhm.
that's appreciated so much that you don't want to sell it, you don't want to incur that income
Right.
tax, the capital gains tax on it. But, you know, you're afraid that the tech industry is gonna go bust and you want to go ahead and get that out of your assets. You could put that in there, avoid the capital gains, get a current tax deduction for the full amount that it's worth,
That you contribute, right?
that you contribute, and then minimize your risk of whatever that stock is.
Right,
Okay,
So when, as a nonprofit, then if I was to sell that stock, right? Cause they, how would that?
Because she's already sold it.
Oh, so,
yeah,
so you've invested in, I'll use the example, Fidelity.
okay,
They have portfolios and their donor advised funds. Oh, are you aggressive or you want to be conservative? And
so
then
they reinvested.
they reinvested, and then you just get online and say, oh, let me set it up so it goes to the Auburn University Foundation with the specificity that it goes to the Women's Philanthropy Board. And that's important, because otherwise may go into a black hole of the Auburn University Foundation, not that it ever does, but it may, okay? So you need to have that subline.
Yeah, because you can't itemize this itemization thing. Even things like dues is, you're under that
That's
bar
right.
of itemizing, so this would be the only way around it.
Yeah, and if you could budget them all,
We'll bunch it all into the
bunch it all under the
debt,
dam.
pay for the next 10 years.
Right.
that's the business.
Is there a maximum amount you can put in?
Not that I'm aware of.
Okay.
I could be wrong, but it's, and what's really great, you don't have to distribute it anytime. You can just, I am sure there's some kind of time frame, and I know they're talking about legislating a time frame in there. But you could say, I'm gonna let it sit for 5 years and just distribute it later on.
And it's gaining tons, it's gaining value,
And-
and it's basically a mutual fund
pay-
or an investment
Sure.
fund while it's sitting in the DAP.
And this whole disclaimer, it's like, it could lose money.
It's like any portfolio.
Any portfolio.
Got it.
And you just pay interest, a tax on the interest.
No,
You don't pay.
It rolls back in, and you don't pull it.
it's a nonprofit. They don't pay taxes,
Okay,
right?
I thought it was earning money.
It is.
But it's not in your name.
It's not in your name. You officially gave that money away to a nonprofit, meaning,
Oh, I create a nonprofit.
no.
They are a nonprofit. So the organization that does that for you is a nonprofit. You give them the money, but you're still in charge of the money.
They're not really, we're technically, you're an advisor. to
You're an
the fund.
advisor.
On paper, but in reality, you still control it.
You control the distribution if it is to a legitimate 501c3 that is registered as a 501c3.
Now, the college counts, like college student fund is very similar to that.
Okay.
You take your big contribution, you take your deduction when you put the money in it, you're gifting the money to the beneficiary student. But you still control the funds and will distribute it when they go to college.
Right, very good. That's
Very-
exactly right.
The thing to know about this though is you get the current income tax deduction when you put it in the donor advised fund. But then 5 years from now, and you're doing a distribution from that, you don't get a second tax deduction for it.
Right.
No,
that's
you've
correct.
already done it. You've already done it.
Right, all right, we're gonna have to, we're running a little short here, so let me go through.
My brain's rolling. This is hidden, this did something.
Qualified charitable distribution, I don't know if you're all familiar with those. For the life of me, I don't understand why nonprofits are not jumping all over qualified charitable distributions. If you're age 70 and a half and you have an IRA and you don't need it for income, you can have, you can do a qualified charitable distribution, which is directly to a nonprofit. Okay, no, you don't get taxed on it, but it's not tax deductible either. For example, like it's typically in the upper left, right-hand corner, I see the red X. Typically, as a taxable IRA would go to an IRA owner, they'd have to pay income tax on it. Instead, you say, oh, I have a charitable, I'm over 70 and a half. And I want $1,000 from my IRA to go to the Women's Philanthropy Board. Just,
So it's a percentage of your IRA?
you can designate, if you have a required, if you're over 73 now, for required minimum distribution, but for this, you have to be over 70 and a half for the qualified charitable distribution. Okay, and it's a great tool for people, and nonprofits ought to be looking in their database saying, okay, I've got these 10 people that are over 70 and a half that contribute to my nonprofit. I'm gonna go talk to them because they need to know about this.
Because it maximizes what comes to the charity. And the donor doesn't feel like a normal $5,000 gift would really only feel like $3,000.
Right.
Because they're avoiding paying an income.
And they're not paying an income tax on it, okay? And the charity's getting the benefit of it. It's great. So let me keep moving along. So there's okay, and then the last one is charitable gift annuities, which we call split benefit. So let's say you do need your IRA for income, but you also you really believe in the Women's Philanthropy Board. So you have a spouse or not, and you can basically, it's sponsored by large nonprofits such as universities and hospitals, such as Auburn University, or East Alabama probably has them as well. And it's good for mixing and matching. It basically provides you an income for the rest of your life. And the remainder of it, of what you give to the charity, goes to the nonprofit. So there's two beneficiaries, you and your spouse, or your spouse, and the charity. Now, there's a certain amount that has to go to the charity, so the interest rate they're paying you is set by a standard thing for nonprofits, for sponsors of charitable gift annuities.
Based on your life expectancy, right?
Yeah, it's based on your life expectancy and the fact that I think they have to take 10% of the amount of donation as a remainder to them. And that's all in these actuarial calculations, okay? And that's what it looks like in the picture wise. You have appreciated assets, okay? Your stock going to the CGA sponsor, which is the Auburn University Foundation or a nonprofit like a hospital. Beneficiary upon death, they get the 10% or more, and the lifetime income to the owner and the spouse. Okay, so it's called split beneficiary, just like a charitable trust is a split beneficiary.
So they basically hold 10% off the top to do the calculations.
The actuaries are the ones that calculate all that,
Yeah.
and so that affects your payout. And so,
And if you're doing it on a one life,
right,
income or two life income.
right. So, once again, it has to be you and or your spouse and jointly, okay? As I recall, I'm not providing advice, I'm education here. Okay? So there's all three of them. These last three, the donor advised fund, the qualified charitable distribution, and the charitable gift annuities. Now, can we have some more fun? Let's go to the combination strategy. Okay? I know Kim likes it because it's creative. And she's very creative. So you have a taxable IRA, appreciated assets, and the donor advised fund. Okay, you have a big IRA. You say, I want some of it to go to family, but they're doing pretty well. They don't need too much. I want most of it to go to charity. So I set up a taxable IRA. I split my big IRA into two because I like to keep it clean. I set one up as goes to my family. It goes to whatever I want them to get a certain amount of money. And by the way, they also know that their children can disclaim it and go to the grandchildren. But whoever gets that money is going to pay taxes on it, okay? So then the other part of the money, let's say they make it easy, a $500,000 IRA, $250,000 goes into one IRA here. The other one goes into a donor, the beneficiary becomes the donor advised, the family donor advised fund. Okay, so from what I talked about earlier, does the beneficiary of this taxable IRA number 2 have to pay any taxes?
No.
No, because it's going to a charity. Okay,
And the person who just split it gets the tax deduction immediately.
well, that person is deceased,
Okay,
okay? It's in-
that's a
it's in the
yeah,
tax-
okay.
It goes as a beneficiary to the family donor advised son, because I'm a family and I'm a father and I want my children and grandchildren to inherit the values that are important to me. You know,
Mhm.
education being one of them, for example. Okay, so it goes into the donor advised fund. So the 250,000 goes into the donor advised fund, or it could be appreciated assets. So you may have funded it with appreciated assets during your lifetime, and then it's the beneficiary of your IRA. Okay, and then you appoint through Fidelity or whatever, the new advisors to the fund if you are there, because it's in perpetuity. So all my children or my grandchildren are going to advise the fund that I set up, and they are going to recognize every time they make a donation that that it's really important to Papa that we set up, that we make this, that we are charitably inclined. It's important to us. Does that kind of all make sense to you? Okay, so that's the thing about it. That's a combo strategy. So you got appreciated assets, you got beneficiary of an IRA, you got donor advised fund. Okay, qualified charitable distribution with a charitable gift annuity. This is awesome. It just came about in December. Okay. Talk about the taxable IRA, instead of going to the owner, it goes to a nonprofit 501c3. So let's say it was sponsored by a large foundation, okay? Now, we're gonna have a charitable gift annuity that same nonprofit also offers, because now you can make it, you can make a qualified charitable distribution to a nonprofit. But they can also take that now and put it in a charitable gift annuity, so you can get income, and with the remainder going to the foundation. That's new. They didn't allow you to do a qualified charitable distribution to a charitable gift to the foundation and put it in a charitable gift annuity. December and the Secure Act 2.0 that they just signed off of, you can do that now. Up to $50,000, I think it's up to $50,000, and it's only a one-time life event. Okay,
Then you still pay taxes on the income from the gift annuity.
yes, you pay income taxes over your lifetime, so it's spread out, and I think it has to start within 1 year of when you set it up.
And if you just did, without the combo, you just did a charitable gift annuity, you still pay income taxes on
Yeah.
that too. So,
Yeah.
okay.
Okay, but now you have a qualified charitable distribution that can go. So if you say, wow, I really don't want that income now. I don't really need it now, but I got this IRA. So let me set up a charitable gift annuity that's going to start a year from now, when maybe my income is going to change a little bit. I'm just stopped working or whatever. So it provides some flexibility in terms of that, but it provides lifetime income for you and your spouse if you're married. Okay. I covered a lot of territory here. A lot of idea. Hopefully you all got some ideas on possibilities for your own situation, or just as important for your loved ones, on how they can benefit if you want them to. Because some people say, I'm gonna spend all my money and just go to Europe and around the world, and they're not gonna have anything, which is your choice, depends on what you want. Avoiding the ugly, I just thought I'd throw this in there. Become a super learner, the more you know, the better you can avoid the ugly. You can avoid the disruption of a family love letter with a lot of conversations, and the family love letter, that is part of that, and fairness. What is fairness? It becomes a problem when you have a family business and multiple children in there, and one person gets the family business and the other ones don't. How do you make that fair? That can be a challenge. Avoid capable, trustworthy appointees. If you have your children are going to be your power of attorney, or they're going to be a trustee of the trust, do they have a good head on their shoulders? And are they trustworthy? I mean, I hate to say that, but there's a lot of instances of people taking advantage of family members. Once again, a family love letter conveys the communications and fairness. Avoid unintended consequences. It really is important, if you are capable, confident, and comfortable, that you lead your family. I mean, I don't mean it in a formal sense of saying, but at least ask the questions, pose the possibilities, recognize that you may know more than they know, and that you can lead a parent or you can lead a child, especially a life learner that doesn't have the life experience or the knowledge. And sound stewardship and the estate documents to be completed, obviously, and reviewed periodically. Avoid excessive taxes and fees, defer and shelter, wise planning, documents completed. Once again, you can avoid, most people can avoid probate and the whole concept of going to the courthouse and registering stuff. This got to be a little bit of planning and some conversations and figuring it. The hardest thing is figuring it all out. So I think that does it. And I think we're on time, and I'm sorry if I was talking so much, but there was so much information, and hopefully you all got something out of this that could be really valuable for you in your own family and life journey situation.
At least have a better idea of what questions to ask.
But yeah, that's the key, having the questions to ask. And then if you can go home and say to Brian, hey, Brian, I understand now we can do a qualified charitable distribution into a charitable gift annuity. Think if you did that and you went into an advisor that was not your spouse or some, you basically probably know more than they know, because most advisors, unless they're a philanthropic advisor, it's not their wheelhouse. They're not their skill set. They may be investments or even planning, but for philanthropic planning with the family, that combination is rare. You all got questions? I threw a lot out. Do you want conversations? I know we're about at the end of time here.
No, but I learned a lot. Thank you.
Well, good. Well, good. You learn enough to know what you don't know, but you got some questions to
I
ask.
have some questions to ask. I did not know about the DAF.
Okay. Well,
That to me was the most interesting thing today,
that is very common now.
especially since we're just preparing for taxes right now. We're going through, and like,
Especially.
can't itemize that this year,
Oh,
because
no.
we can't itemize that anymore. So when you hit on DAF, I was like, wait a minute,
Bingo.
there's a loophole. Yeah.
Yeah,
So then it's a matter of figuring out, do you want the hometown community foundation or?
and the bunching, that was something
Yeah.
new too,
Mhm.
right?
Yeah. So,
Holding. and-
Well, the donor advised fund and bunching is kind of the same thing, right? Because to truly get a benefit out of, get a tax deduction for putting money into the donor advised fund, you're still gonna have to get it to that level where you can itemize.
And the chunky